Welcome back. In our top business story, the International Monetary Fund, despite it taking into account the current uncertainty and gloomy global economic outlook, foresees a strong 7% growth for the GCC region next year. Masoud Ahmed, director of the IMF's Middle East and Central Asia Department, which launched its regional economic outlook for the MENA region, Afghanistan and Pakistan here in Dubai today, said the UAE economy is in a good position. However, it must proceed with caution, he added.
This year we expect growth in the UAE to be close to 3.5%, about the same between the oil part of the economy and the non-oil part of the economy. Non-oil part is being boosted by trade and logistics. At the same time, you do see now a slowing down in the world economy, and that will affect the UAE to some extent. The UAE is, however, quite well prepared to deal with this slowdown, in part because the banks in the UAE are now in a much stronger position. Their capital adequacy ratios are much improved compared to 3 years ago, and in part also because a lot of the restructuring of the debt of the GREs has been done, and now the challenge will be to make sure that that process continues and that there are buffers built into the system to prepare for any downturn in oil price.
Looking at the entire MENA region, Afghanistan and Pakistan, continued high crude oil prices improved the economic activity for most of the region's oil exporting countries, along with their fiscal budgets. Therefore, IMF experts their combined GDP to pick up in 2011 by growing 5% to then fall back to 4% in 2012. Masoud Ahmed said the future ahead for all of the region is looking good, despite some bumps on the road.
The oil exporting countries in the region are doing relatively comfortably this year, in part because the demand for oil has gone up and the price of oil is also better, so they have been spending some of those resources, and so the rest of their economies are also growing well, overall about 5%. The oil importing countries in the region, I'm talking about the developing countries, the emerging markets, they are feeling more pressure because they're paying more for food and fuel, more pressure because tourism and investment flows are down, and also because in a number of these countries they're going through a political transition, a social transformation, and this is uncertainty is also having an impact on economic activity.
Investment Corporation of Dubai and Brookfield Asset Management will seek up to $1 billion from a joint investment fund set up to invest in the Emirates property market. ICD, which is Dubai's main investment vehicle, and Canada's Brookfield will each contribute to the fund with $100 million in capital and seek additional funds from a select group of local, regional and international investors, a statement said. The fund will then target a wide class of assets in Dubai in both freehold and non-freehold areas. The fund size will be capped at $1 billion and it will have a life of 8 to 10 years, the statement said. And let's now look at the stock indices across the GCC. World business news. Not only Greeks, the entire financial world eagerly awaits the results of today's EU Council summit, the 14th crisis summit in 21 months that is to decide on how to cut Greece's debt, boost the rescue funds, firepower and recapitalize European banks. However, the prospect for a comprehensive deal to resolve the debt crisis look dim. While there appears to be a consensus on the recapitalization need of Europe's banks for around 110 billion euros, there's little clarity on how to reduce Greece's debt burden and how to scale up the region's 440 billion euro bailout fund, the EFSF. EU leaders have two options. One, by using the EFSF to offer guarantees to buyers of new Eurozone debt, and the other, using part of its capacity to set up a special investment vehicle that would attract money, for instance from sovereign wealth funds, to buy debt. They might also agree to combine both options. Investors will wait to see the details of how the EFSF capacity is increased. We asked Philippe Dauba-Pantanacce, senior economist at Standard Chartered Bank, how he thinks the rescue fund will be remodeled whether this will really solve the EU debt crisis and whether Italy is doing enough to convince investors it will not face the same fate as Greece.
Well, first of all, what is for sure is that we think that tonight's meeting of the European leaders will fall short of market expectation. In terms of the rescue fund, it looks like we are gearing toward a sort of a guarantee scheme. First, the fund would guarantee a portion of the peripheral debts to encourage private investors to continue buy sovereign bonds, likely targeted to Spain, Italy, and possibly Belgium. The guarantee is going to be set at 25%, which means that the fund will be leveraged about 4 times and reach probably 1 trillion euro. Merkel reported that the rescue fund firepower would be raised to at least 1 trillion euros, but at best, nothing more specific than a range will be announced at today's meeting. So in terms of Italy, indeed, Italy needs to deliver by tonight. Italy is under tremendous pressure to accelerate reforms in the labor market, but also to lift administrative burdens on business in order to boost the country's growth potential. They have already missed the deadline to deliver reform by end September. So again, there's a major political crisis right now actually in Italy. So I don't think that tonight will give us all the answers that the market expect, and there might cause more volatility on the market going forward.
Consumer confidence in the U.S. tumbled to a 2.5-year low in October on concerns about jobs and wages. This caused online retailer Amazon.com to report a third-quarter net income that was 73% lower than a year ago. It even had to warn on its profits. Amazon's operating results may see a loss of up to $200 million this year. Reason being that the company is ramping up spending as it gets ready for the debut of its next line of Kindle tablets. Especially the competition with Apple's iPad is costing Amazon millions. The new Kindle Fire will cost $199 each. At that price, the company will lose $10 per device, research firms say. Before we go, here's a quick overview of the oil, precious metals and currency markets, and after that we have the day's sports news for you.